Call to order the July 31st Santa Barbara City Council Finance Committee meeting. And we have two items on our agenda. But first, if we have any public comment from anyone who'd like to speak on any items that are not on our agenda. Seeing no one, we'll go to the first item, which is the proposed reserve policy change. Mr. Samario?
Yep. Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. I'm just going to give a quick intro, then turn it over to Michael Pease. He's the business manager for Public Works. I wanted to provide some context. So in 96, and Mr. Hart, you might have, I'm not sure you were here for that, but 1996 is when the city first established its reserve policies. And that was, on the heels of a recession and all that. And that policy has been in place essentially unchanged until now, except for one change we made in 2012. And that was really to tweak it for two areas. One is to provide a little more strength in terms of when policy reserves can be used in the general fund, and it has to be accompanied now with a plan to restore it. But the other thing we did was we, for the first time, imposed or added a reserve requirement for internal service funds. Not all of them, but most of them. And the Facilities Management Fund was one of them. And it basically said we're going to set up a reserve requirement of 10%. It wasn't designed to speak to disasters like we have in the general fund or enterprise funds. It was just for operational purposes, unexpected ups and downs in either costs or revenues. So we're here to speak to that policy related to internal service funds and to this facilities management fund and how we're proposing to tweak that even more since 2012. So with that, I'll turn it over to Mr. Michael Pease.
Mr. Pease, thank you.
Thank you, Mr. Samario. I'm Michael Pease, Public Works Business Manager. Chair Hart and committee members, I'm here to talk today about our proposed reserve policy change in the Facilities Management Fund. So I'll give a little bit of background as it relates to this fund and our reserves in this fund, and then talk about the proposed policy change. So starting back in fiscal year 14, back then we had reserves above policy. And we also had some significant capital maintenance that was being deferred. And so considering those two factors, we evaluated the need for excess reserves within the facilities fund. And so part of that evaluation, we looked at risks to the funds in that particular facilities fund that may draw on the reserves themselves. And so those often will be something that's of an unexpected nature, maybe an equipment failure, a roof leak, something of that nature. And so looking at those risks, we felt that an interim policy goal of $250,000 was sufficient to cover those kind of unexpected issues. And so we requested that, which would bring us below the policy reserves. And that allowed us to put the excess reserves to work on some of the critical facility capital needs at that time. And that was something I'll just also mention that was something we mentioned during the budget process that year with the council. It was just something on an interim basis to get at some of those critical capital needs. So now looking at fiscal year 19, we again are evaluating our reserve policy needs, looking at the risks to the revenue stream in the facilities fund. Again, the unexpected issues, roof leaks, equipment failures, things that, unexpected damage to city facilities, things like that our facilities fund would need to get at. And we also have an ongoing capital maintenance deferral. We still have an ongoing capital maintenance need in the fund. And so that brings us to our proposed policy change, which really is meant to balance the appropriate reserve level with prioritizing getting at this critical deferred maintenance to help really avoid any costly repairs that we do on an urgent basis. So if something happens unexpectedly because we're not able to get to the planned maintenance, that's going to cost us more in the long run. And so we'd like to put these reserves to work on an ongoing basis. And so proposing this policy change would allow us to do that on an ongoing basis. And so looking at it in summary, our current policy is a 10% of the operating budget in this fund, which with a $7.6 million budget puts us at a reserve of about $762,000. I talked about the interim goal that we've been using to try to get at some of those capital needs of $250,000. The proposed policy change today is to have a reserve of 10% of the building maintenance program budget, which is really the program within the facilities fund that would get at some of those unexpected issues that may come up. And so that would put us at with a $2.9 million budget, it would put us at about $296,000 a reserve. And that's more than our interim goal, so we feel good about that part of it. And so the result would be balancing the interests of the city, an appropriate reserve level for unexpected issues, while also getting at some of the critical capital needs rather than having the money sitting in reserves. And so it would really free up at least another $466,000 that we could put toward those capital needs. So today we're asking for your recommendation of the proposed policy change for approval by City Council.
Thank you, Mr. Pease. Are there questions? Councilmember Friedman?
Can you remind me again of our overall city reserve policy? Go ahead.
Yeah, so it's looking at it from different fund types. So we have a general fund reserve, which Mr. Samario was talking about. We also have the enterprise fund reserve policy, and then what we're really talking about with this fund is the internal service fund policy, which is just one reserve of 10% of the operating budget. And so we're proposing to change that from 10% of the operating budget to 10% of the building maintenance program budget.
And so this wouldn't affect the overall city reserves that we have, our city reserve policy.
No.
Not in any other fund besides the facilities maintenance fund.
And then how did you, you're trying to get to the $250,000 level for this. How did you arrive at that number as being sufficient to meet your needs?
It was looking at the risks to the revenue streams in that fund, how much, what kind of costs we could incur on an unexpected basis, such as roof leaks, such as equipment failures, things of a smaller nature, and that's how we got to the 250.
And so I take it, just from my understanding, is that by putting more into these issues now and the preventative maintenance, that you would actually decrease the likelihood of having to use reserves on an emergency basis.
Exactly.
Makes sense to me.
Any other questions? Councilmember Dominguez?
So is this part of the general fund, the 7 million or the 2.9 million?
No, it's not.
Okay, so we're not double reserving it.
We are not double reserving. We are reserving the general fund for emergencies, and we are reserving in this fund. I don't know if you consider that double reserving, but for the unexpected needs, that we're looking at for 10% of the operating budget or 10% of the building maintenance program budget, it's looking at the unexpected issues that could be impacting this revenue stream in this fund.
Yeah, by double reserve, I just mean if this was part of the 300 plus million in the normal general fund process, then we would have a double reserve. I'm not sure if that's the right accounting term.
Yeah, so the $300 million number is citywide. We have individual funds. And our policy really governs what we call operating funds. So we have a lot of funds that really think about fleet management or replacement. We're just replacing vehicles, very little operations involved. We didn't think at the time in 2012 or even back in 96 that we needed a reserve for that. But in the facilities, there's enough operations going on that we thought it needed a reserve. It's just that that fund encompasses communications, telephone, and custodial services, things that really don't have any sort of ebbs and flows. We don't have any need to have a reserve in those programs. But we do believe it's appropriate to have a 10% reserve within the facilities portion of that, to maintain that. So that's where the 10% comes in. But it's separate from what we have in the general fund, what we have in our enterprise funds. They all have their unique reserve requirements. This is just for the internal service fund within that program, within that fund, that we think is appropriate to have a 10% reserve, and that's the $296,000.
Great, thank you.
And you just answered one of my questions about the difference between the expenditures in the adopted facilities operating budget and the building maintenance program budget. Does the history of having those unplanned events, the cost of those events, is there a cost history that gives us comfort about this $296,000 reserve that covers most events that have occurred historically?
Chair Hart and committee, and Mike Wiltshire, Facilities and Energy Manager. Historically it's less than the $250,000, and really these sort of events are driven by lack of maintenance.
Right.
The types of things we see are when there's a storm, our roofs that are 10 years past their useful life will leak, cause water damage. We'll spend 10 to $100,000 repairing drywall and roof and leaks. And so the intent is that instead of having this money kind of sit dormant, get out ahead of some of this stuff and avoid these deferred maintenance problems that kind of lead to these emergency repairs. But historically, we haven't had anything larger than $250,000 in the way of a facility maintenance issue. And we need to kind of separate these things. Like Mr. Samario mentioned, it's not necessarily intended to reserve against some giant disaster. That's a different issue. It's really just internal to this program.
Well, that makes sense. And, you're trying to fit the balance point between putting all of that money to use to eliminate deferred maintenance, but at the same time having some protection against events. And so this is that, trying to find that sweet spot is the real question. And that's so historically, if the expenditures are less than that $250,000 and you're proposing, to do 10%, which today is $296,000, you're comfortable that any of those events that are going to occur are going to fit within that amount. And so we're putting the maximum amount of money into eliminating deferred maintenance, but at the same time protecting against the historical range of events that do occur, which is what you're trying to do is balance those.
And I like the $250,000 number, but this just makes more sense tying it to something that moves with time. And so it's tied to a program at 10% that'll kind of grow with inflation over time so that it's actually pinned to something meaningful instead of just a fixed number.
Perfect. Well, thank you, Mr. Wiltshire. That's an excellent answer. Any other questions? Councilmember Dominguez?
On your slide, you use the phrase critical deferred maintenance needs. What's the ballpark figure of that category?
Chair Hart, Committee Member Dominguez, this kind of dates back to the budget presentation. Our deferred maintenance sits at about $2.7 million a year. I think on that chart, our regular budget feeds about $1 million into that, and with the addition of Measure C, we're at about $1.2 million. So add
1.2 total?
No, about 2.2 to 2.5 total, depending on what goes on with Measure C. And so then we're looking at kind of $300,000 to $400,000 a year in deferred maintenance. In the early terms, I would consider all of that critical because we've been really up against this backlog for quite some time. So if we were to try and get after that all now within the next few years, it would be a pretty horrendous cost, and I consider it all pretty critical in the first 5 years.
I'm just concerned with the fluid use of the word critical because we want to avoid a situation where we're crying wolf or so is there a facilities definition for critical? Is it something like a roof that's beyond its life, or how does the report you generate differentiate between critical and just deferred?
Mainly roofing and mechanical equipment. So anything that's involved with a roof that's beyond its useful life. I mean, we still have during storms, there are a dozen buildings that will leak. And so anytime you get water penetrating into the facility like that, it can just open up a can of worms. So I consider any roof that's not performing its job of keeping water out of the building a critical maintenance need.
Well, and that concerns me that you're telling us today that we have a bunch of roofs that aren't working. Is that what you're telling us?
Well, they're above us, they're sustaining, but we do have roofs that leak during storms. And we're working to repair those.
And what's the timeline to getting those all fixed?
As soon as possible. But this is all in with our Measure C funding and our deferred maintenance funding that's coming this year. We prioritize roofs.
Yeah, and I think just to put this in context, the city has been struggling with addressing deferred maintenance for decades, and we were very fortunate to have the voters approve Measure C, which provides us a significant new funding stream that is now being able to address the issue that did not have a solution previously. The past fiscal situation was that there weren't revenues to address that backlog of deferred maintenance, but now we're in the position where we're working through a transition to where we're going to get on top of all of those. And so there's a little bit of time that's necessary to move from there wasn't a path to there is a path, and we're going to get to that situation where we don't have those problems, but it's going to take a little bit of time. And that this is a piece of that puzzle, because you're going to be able to dedicate the $400,000 to $500,000 additional money on an annual basis to plugging the gap that you just described, and that this change in policy is exactly what's necessary to achieve that goal.
Yes, and Committee Member Dominguez, just to touch a little more on your question. Historically, we've replaced 1 or 2 roofs a year, and now with the introduction of Measure C, we're slating roof replacements at the East Side Library, Fire Station 3, Fire Station 4, and Fire Station 5 this year. So that's already accelerating our previous funding levels to roof replacements. And a lot of these minor renewals that we spoke about in the budget, those are all driven predominantly by roofing replacements. So that kind of comes first, and then we'll deal with the building inside of that. So even as soon as this fiscal year, we're going to be accelerating our program to replace some of these problematic roofs.
Is there a motion from anybody?
So I just wanted to ask, because you said on an annual basis. This isn't on an annual basis, is it? I just wanted to make sure we're not proceeding. This is a one-time, because once the reserves dropped, we're not getting that increment anymore.
Yeah, it really is just the delta between the policy goal, and so it'll free up roughly $500,000 to use either
Once.
one time
Okay.
or a couple $100,000 a year until the reserve policy is met.
Would it be a tremendous amount of work to send us a list of like the rooftops that are the ones in the critical stage and kind of the timeline?
Yeah. We did recently, with some of the funding that we freed up, we just recently had a number of citywide facility audits done, and we're kind of feeding that into a capital program model. And so that would be a good time, is when I get all that data back, I can come back and report on what the output is of that. I have a list of roofs that do need replacing now, but it would be nice to kind of paint a bigger picture.
Okay, great. Thank you very much.
Is there a motion?
Second.
Motion's been made and seconded to recommend the staff recommendation to the City Council. All those in favor say aye. Aye. Oppose? None. And abstain? None. Matters carries unanimously. Thank you, everybody, for the presentation. Next up is the quarterly investment report. Mr. Samario, is that going to be you?
Thank you, Mr. Chair. So, Bob Samario, Finance Director, I'm here because Julie Nemes, our previous Treasury Manager, is no longer with us. She's in West Hollywood, but we, as you maybe saw in an email recently, I have appointed or selected a replacement. It's Ms. Jennifer Tomasewski. So she is, as you know, she was our accounting manager and now is our treasury manager. And for the next several months, because of the CAFR and all that, she'll be kind of working dual roles until we get that filled. But so in subsequent meetings, she'll be making the presentation. And I also want to remind you that we asked this committee, I think, a quarter ago, maybe 2 quarters ago, how frequent would you like to see these reports? And remember, I think we agreed that we would be doing these semi-annually. So this is sort of a year-end report. And then we'll come back to you again in January, February with the second quarter after 6 months. So you won't be seeing us every quarter like we have in the past, just to remind you of that. So this is a report for the fourth quarter ended June 30, 2008. So it's last fiscal year still. And what I really want to cover, in broad terms, separate from this outline, is, and this is really the purpose of the report, is just to show you and to describe the performance of the portfolio this quarter in terms of primarily interest earnings and the like. What activity we had the quarter, so what purchases did we have and what maturities did we have. And then the interest rate environment, we talk a little bit about that because that's obviously what drives, our interest earnings. And then lastly, just go through what the balances are at the end of last year. So I apologize. This is some real basic stuff. Rather than go kind of what Ms. Nemes has in the past, I wanted just to kind of come up with to talk about some basic concepts, and I'm sure you know most of this, if not all of it. But in terms of what's driving interest rates that generate interest earnings for us, it's really federal monetary policy, and that means that they basically control or influence interest rates by affecting short-term interest rates that are charged to participating banks in the Federal Reserve System. And by doing so, they affect then what the banks will charge their businesses and companies for borrowing purposes. So if they feel like the economy is really heating up, then they're going to be looking to raise interest rates. If the economy is sluggish, they're going to be lowering interest rates to try to spur investment. So since December 2015, because we've had a strong economy, and this is more nationally than locally, they have raised interest rates 7 times, including an increase in this past June. So right now, the federal funds rate is, and that's again the overnight money they charge to banks. That's in the 1 3/4 to 2% range. At once upon a time, it was 0 to 0.25%. So it's gone up substantially, but still very low relative to historical averages. We typically, or in the past, we've seen that as high as 4 or 5, 6%. They've also hinted that they will be increasing the rates 2 more times this year, although we'll see if that actually transpires, given what's going on with the tariffs and all that. But currently, their basis for the increase is the economy is still very strong. I don't know if you heard, but the GDP the last quarter was extremely high, higher than it's been in many years. It was 4.1%. I think they might even revise that upwards. The only caveat is what might the tariffs do in terms of the economy, and what might future rate increases do to the economy in terms of, will it cause it to go into recession, which then drives interest rates. So based on all that, the treasury yields that we've been investing in and generating have increased, again, historically low. And we have seen that particularly in the 2-year range, we've seen the largest increase in the yields between March 31st and June 30. So this just shows you month by month, starting with March 31st through June 30, what the various terms of Treasury securities are yielding. The far right is the cumulative change. You can see it's all going up. We invest in basically the 0 to 5-year term. We don't ever invest in anything beyond that per our policy. But just doesn't show you the 10-year and the 30-year, what those are doing. We've talked about this before, and just to re-emphasize it, that our objective is for safety first. So regardless of what's going on in the economy, with the interest rate environment, it really doesn't matter to us other than at the end of the day, it does determine how much we get each year. But we look first for safety, so we're investing in very secure investments that are highly rated. And then we also look to ensure that we have enough money, liquid money, in order to pay our bills. And we talked about under the banking services contract, and in that context, that we typically have anywhere from $12 to $15 million in the bank in just cash in our checking account. We also maintain money in our LAIF, our local agency investment fund at the state, for the similar purposes, easy to draw down versus having to sell a security. But we essentially, and so the yield is last, which means that we just buy into the market. Whatever interest rates are in that time, we're going to buy into that. We just make sure we're sort of evenly distributing our securities over a 5-year period so that they're maturing in a way that provides us the liquidity we need to pay our bills. And this is sort of just a benchmark, which for your purposes in terms of your review of this, it's an indication to you as to whether or not we are investing in a manner that's consistent with what the market is, and we're not being too aggressive or too conservative. The blue line is our portfolio. We're always going to be a little bit behind the other two benchmarks, which is the 2-year Treasury and the LAIF rate. So those two respond more quickly to changes in the interest rate environment. So you can see, like in the middle of this chart, the blue line, we reacted more slowly to the drop in interest rates than the other two indices, because we have a longer than 2-year maturity typically. But as long as you see us going in the same direction and we don't see that spread being too wide, you'll know that we're investing in a manner that's appropriate and not too risky. This is something I wanted to show you just because it sort of adds some interest to the presentation, because I know it's fairly mundane. So this is the Treasury yield curve 2 years ago, so July of 2016. And ignore the far left, because that's the LAIF rate. So if you just look at the 3-month number of 0.28, I think that's what it says. But if you see the angle of this yield curve, you can see it's very traditional. There's a premium for going out longer. So if you're an investor, you would expect a little more premium if you're going to invest longer term, because you're locking up your money longer versus short term. So very traditional, real typical yield curve. It sort of suggests, things are somewhat normal. Then going back to last year, you can see that the yield curve started to flatten out a little bit, so less of a premium to go out. And then now this yield curve is really interesting because it's flattened out even more, but primarily you'll see that where you've seen the biggest bump, and all the rates are higher, but where you've seen the biggest bump is in the middle, in the 2 to 3 year range, which is interesting. So there isn't much premium to go out 3 or 4 or 5 years, not much more than just investing in 3 years or even 2 years. And this, again, doesn't really mean much to us other than we know we're investing in this environment, so we're probably going to be biasing toward more of a 2 or 3 year security, but not to a large degree, because we still got to fill in that 5-year sort of window. So we're still investing in 5-year securities and 4-year securities, because that we want to make sure we have an even maturity ladder, if you will. but it's just hard to invest longer term because, you don't get that premium. This speaks more to me what's going on with the economy and what the future holds for the economy. And there are books written about what a flat yield curve means, but most economists will tell you that one potential indicator of this is that we are headed toward some kind of a slowdown or a recession, because it just means people don't have that much confidence in the longer term that they do in the short term. But that's all speculative. There could be other reasons, but I just wanted to show you that. So in terms of our performance, our yield, because interest rates are just going up, did increase a bit. So from March 31st, it was at 1.685. Now it's 1.8%. So that's good. Means more money coming into our budget, our coffers. The portfolio as a whole for the quarter earned $860,000. The general fund portion of that is about $195,000. If you were to extrapolate that, it works out to be about $800,000 for the year for the general fund. I remember not too long ago where the general fund was in the $2 to $2.5 million earnings, if you will, each year. So you can see still historically low earnings and interest rates. You can see our cash and investment balance is $206 million, and I'll point out why that's so high in just a second. This is the activity for the quarter. We're always buying and the like. You'll never see us, or rarely should you see anything being sold, because that's not how we do business. We buy things and hold them in maturity to ensure that we don't ever lose principal. Selling, some cities will be more actively trading and to try to capitalize on the changes in market, but we don't do that. We take a much more conservative approach and just hold it to maturity. But we did purchase $8 million of securities, primarily in the federal agency securities. That's primarily where we go to. And then we had $2 million in maturities of also a federal agency security. This is our portfolio. You can see that it's a much higher number than what you've seen in the past. It has to do with the fact that we get property taxes coming in late in the fiscal year. And we are also holding on a lot of cash because, and I think we've talked about this in the past, in July we make sort of a prepayment to PERS for our unfunded liability. It's about $21 million that we paid out in July. And we do that because rather than pay it every month, we save money by prepaying it. So they discount that substantially. So several hundreds of thousands of dollars that we save by prepaying it. For us, we have the cash to do so. So there's no reason not to do that. But that's why we had a lot of money sitting as of June 30. You can see our state of California LAIF, $65 million. That's the max we can invest in. That's capped out. And we even had $17 million, $17.7 million, the first line, in their checking account, higher than normal, again, because we anticipated this payment in July. Plus, we had other payments that we knew about for property insurance and other kinds of insurance in July. This is just kind of a breakdown of the portfolio. To the far left, you see agencies always dominate where we invest our money. It's just unusual. We'll see that LAIF is a bigger slice of 31% because of the reasons I mentioned, but otherwise pretty typical allocation or distribution. And so we're asking the committee today to recommend council accept and approve the fourth quarter investment report and the fiscal agent report for fiscal year 2018.
Thank you, Mr. Samario, and congratulations to Ms. Tomaszewski on your promotion. Any questions for Mr. Samario? Is there a motion?
Second.
I have a motion to approve the staff recommendation to forward this to the council, and all those in favor say aye.
Aye.
Oppose and abstain. Matter carries unanimously, and we are adjourned.
Great, thank you.
Thank you.